Good morning. Thank you all for being with us today. I call this hearing to order. It has been just about 6 years since the passage of the Dodd-Frank Wall Street reform, and at that time we have seen a steady stream of new rules and regulations imposed upon financial institutions. These hundreds of rules and thousands of pages of regulation have been touted as necessary to secure financial stability and targeting just those large institutions which were blamed for the financial collapse. But as this committee has learned, our small community banks have not been spared from the regulatory burden. Across the country, community banks are seeing the cost of complying with regulations soar, and the result has been less capital available for the Main Street shop looking to expand, for the entrepreneur looking to start a business, and for our neighbors hoping to purchase a new home. The impact of regulation on community banks is felt especially hard in our country's rural areas like my district in Kansas. The rising cost of regulation is causing many small banks to be forced to merge with larger entities that may not understand the local community, or causing them to shut their doors entirely. In rural towns without many other alternatives for access to capital, the results of these top-down regulations can be devastating and impact the whole town and the entire county and region. Home mortgage lending, small business lending, agriculture lending, all areas where community banks play a leading role in providing capital, becomes much more difficult and much more costly to our consumers. And our rural communities are still feeling the harsh effects of the recession. During the so-called recovery, growth in business establishments was reserved for the big cities. From 2010 to 2014, a full half of all new businesses were started in just 20 of our nation's counties, all near large metro areas. During that same time, most rural counties have actually seen a decrease in business establishments. More businesses are closing for good than opening up. At today's hearing, we will hear about the impact financial regulations are having on our rural communities from those who see it every day, including from within my home district in Kansas' Big First District. Discussions of financial reform are often centered on big cities and large institutions on Wall Street, but today we hear from those areas of rural America from Main Street, which can too often be overlooked in these conversations. I thank the witnesses for being here this morning, and I look forward to your testimony. I now yield to Ranking Member Chu for her opening remarks.
Thank you, Mr. Chair. Just 6 years ago, our nation was in the early stages of a recovery from one of the worst economic downturns in history. We lost 4 million jobs, 7 million people faced foreclosure, and families saw over $16 trillion in wealth disappear as the bottom fell out of the housing and stock markets. After taking extraordinary steps to stem the losses and stabilize the economy, Congress enacted the Dodd-Frank Act in July 2010 to address the many loopholes that caused the collapse. The bill established strong new standards for the regulation of large, leveraged financial institutions and made the protection of consumers seeking mortgages and credit products a top priority. Dodd-Frank was directed primarily at the largest financial services firms, and significant efforts were made to ensure that any new regulatory burden on the small banking community was properly mitigated. For example, many of the Dodd-Frank Act provisions only apply to institutions with over $10 billion in assets, leaving 98% of all banks in the U.S. largely exempt. Additionally, the Consumer Financial Protection Bureau has gone to great lengths to balance the burden of new regulations on small banks with the ultimate goal of protecting consumers. Initially, there was significant concern that regulatory burdens would have a negative effect on access to capital for small businesses, but fortunately, it appears to be having less impact than originally feared. According to the PayNet Small Business Lending Index, access to credit continues to improve for small businesses. In fact, lending is up 70% since Dodd-Frank's enactment. Similarly, the Wells Fargo Gallup Small Business Index poll indicates small business owner optimism is at its highest point since 2008. Furthermore, data from federal regulators also points to a healthy small business lending market. The Federal Reserve has found that lending standards for small firms have eased considerably since the recession, while loan and lease balances at community banks have increased $21 billion in this past quarter alone. SBA lending, too, has come roaring back to surpass pre-recession levels. In 2015, the agency made 63,000 loans totaling $23.5 billion. Although the small business lending environment appears to be robust, critics of the Act continue to point to the decreasing number of small financial institutions as proof of burdensome regulation. However, it is important to remember that the decline in the number of community banks is not something that started happening after Dodd-Frank was implemented. The sector has actually been consolidating for the past 30 years. Experts can disagree on the reasons for consolidation in the community bank sector, but I think we can all agree that things are improving. Revenue is up, lending has increased, asset quality is steady, and creditworthiness of borrowers is on the rebound. As both lenders and borrowers, small businesses have much at stake when it comes to financial regulatory reform. The Dodd-Frank Act has the potential to make the entire system more stable and safer for small firms in the real economy to grow and create jobs. It is my hope that the testimony today will add important perspectives on the interaction between Dodd-Frank and Main Street. I want to thank the witnesses for being here today. Thank you. I yield back.
Thank you, Ms. Chu. And let me explain the opening statements and timing for the witnesses. If committee members have an opening statement prepared, I'd ask they be submitted for the record. You each have 5 minutes to deliver your testimony. The light will start out as green. When you have 1 minute remaining, the light will turn yellow. And finally, at the end of your 5 minutes, it will turn red. I ask that you try to adhere to that time limit. And with that, I'd like to introduce our first witness this morning, Mr. Roger Beveridge, who is visiting us today from Oklahoma City, or Edmond. And Mr. Beveridge, it is the former executive vice president of the Nebraska Bankers Association, is currently the president and CEO of the Oklahoma Bankers Association. He has held this position for over 25 years. Mr. Beveridge is testifying today on behalf of the American Bankers Association. And Mr. Beveridge, we welcome you here today. You have 5 minutes, and you may begin.
Chairman Huelskamp, Ranking Member Chu, thank you so much for the opportunity to be here today to visit about how the growing volume of bank regulation, particularly for smaller hometown banks in rural areas, is negatively impacting consumers. Let me be clear. Banks are a resilient group. They have found ways to meet customers' needs despite the ups and downs of the economy. But it is a job that has become much more difficult because of new rules, guidances, and the seemingly ever-changing expectations of federal banking regulators. It is this cumulative impact of regulatory overload that often pushes small banks out of existence, either to merge or to sell. In fact, there are nearly 1,500 fewer community banks today than there were just 5 years ago. When I came to Oklahoma in 1988, there were well over 400 banks in our state. Today in Oklahoma, there are 211 that are chartered by the state of Oklahoma or a national bank doing business in Oklahoma. But more frightening to me right now is the seeming lack of interest in granting new charters. This trend apparently will continue unless changes are made that provide relief to community banks, but particularly those that serve rural areas. Let me also be clear about the kinds of banks I'm talking about. These banks are very small. In Oklahoma, for example, out of the 211, 97 of them are under $100 million. 46 are under $50 million. Those are very, very small banks that had nothing to do with the financial crisis that led up to the issues of 2008 and Dodd-Frank. In Kansas, you have 156 banks that are under $100 million in total assets. These banks have a handful of full-time employees, and they all perform a lot of different functions. There's no one functionality that you have in a small bank like that. These are the kinds of banks that serve rural America. Regulation shapes the way banks do business and can help or hinder the smooth functioning of the credit cycle. But every regulatory change that applies to America's hometown banks directly affects the cost of banking products and services for consumers. Even small changes can reduce credit availability, they can raise costs, and what the ranking member talked about is driving consolidation. We've seen that considerably in our state. But what that does is ultimately those three things limit consumer choice. I believe Congress must take steps to ensure and enhance the banking industry's ability to serve their consumers and rural areas. When a bank reduces its product and service offerings or disappears, everyone in that community is impacted. Importantly, in rural communities, local banks are, in many instances, the exclusive source of capital for farmers, ranchers, small business owners, and residents. Once that capital access system becomes dysfunctional in rural areas, as it is today, then the community itself begins to encounter more difficult challenges in order to survive. We ask for bipartisan support for legislation introduced by Congressman Tipton that would require regulators to tailor bank supervision that would take into account the charter, the business model, and the scope of each bank's operations. Regulators should be empowered and directed to make sure that rules, regulations, and compliance requirements only apply to those segments of the industry where warranted. Representative Barr's American Jobs and Community Revitalization Act also contains provisions that will reduce regulatory requirements for smaller community banks in ways that make it easier for those banks to meet their customers' needs. Additionally, Congress should help reduce needless impediments to mortgage lending that have constrained the ability of community banks to help home buyers and dampen the growth of prosperity across our nation's rural communities. In Oklahoma, approximately 25% of the state's banks are no longer in the home mortgage business. They've concluded that the litigation and regulatory risks are simply too great given the limited number of those kinds of loans that they make in a given year. That means that the consumer is denied credit or has to find some other source for it. We encourage the Congress to support legislative efforts like H.R. 1210 that would treat loans held in portfolio, which is one of the most traditional and lowest risk lending in which a bank can engage, as qualified mortgages. This would provide a much needed correction to the current restricted standards. There's additional legislation introduced by Representatives Lutkemeyer, Nagelbauer, and Barr that contain measures to help America's hometown banks get back to serving their communities by ensuring that costs and benefits are considered before changing or issuing new regulations, to streamline currency transaction reporting and require a review and reconciliation of existing regulations. ABA stands ready to help Congress address these important issues that will in turn help community banks, particularly those in rural areas, better serve their customers and their communities. Thank you very much, and I'll be happy to try and answer some of the questions you may have.
Thank you, Mr. Beveridge. I appreciate testimony. Our second witness this morning is Mr. Shane Haynes, who is visiting us today from Elkhart, Kansas, which is located in my home district, Kansas Big First. Elkhart is a community in southwest Kansas with a population just over 2,000 folks, and I might add 26 graduates in the senior class, and where I come from, that's actually kind of a big school. But for the past 9 years, Mr. Haynes has served as president and CEO of the First National Bank of Elkhart. And by the way, when you're in Elkhart, you're not quite in Oklahoma or Colorado, but you can see him from there. And previously has served as president of the Kansas Ag Bankers Division of the Kansas Bankers Association. Mr. Haynes, we welcome you here today. Thank you for joining us, and you may begin.
Thank you, Chairman Huelskamp, Ranking Member Chu, and members of the subcommittee. My name is Shane Haynes, President and CEO of First National Bank of Elkhart, Kansas. I appreciate the opportunity to present the views of rural banks and the impact of overregulation in rural America. First National Bank is a $78 million bank with a main bank location in Elkhart, Kansas, the county seat, and one branch serving Raleigh, Kansas. We have 20 employees, and we are a typical ag bank. Despite our small size, we are the largest lender in the county and represent an average-sized bank in rural Kansas. I've been very proud to be an ag banker in a rural community for 20-plus years. There are days we can still get in our unlocked pickup truck to go to work in the morning and have cash lying in the seat. We simply take it to work as it's a payment from a customer who will call us eventually and tell us which of their loans to apply it to. One of my loan officer's customers actually won a multi-million-dollar lottery, and he didn't feel safe holding the ticket in his possession over the weekend. So he took it to his loan officer's house, didn't want us to put it in the vault, just wanted him to hold the lottery ticket for him over the weekend. That's community banking. That's what it means to be a community rural banker. When I started in lending, a typical consumer loan was one page, and the consumer would actually read the note and disclosure. Now, a typical consumer loan is closer to 20 pages with many documents to sign, and customers have no interest in reading that many documents. We've made a simple loan so complicated that customers simply won't read the documents. The topic of today's hearing is very timely. Increased regulation has made it much more difficult to lend and be a main driving force in our local community. Despite this, the banking industry is well positioned to meet the needs of rural America. In 2015, farm banks like mine increased ag lending 8% and now provide over $100 billion in total farm loans. Interest rates continue to be near record lows, and banks have the people, capital, and liquidity to help rural America through any turbulence in the rural economy. Rural banks are healthy and continue to be forward-looking, growing capital and increasing reserves. I would like to thank Congress for its commitment to the guaranteed lending programs, both SBA and USDA. However, I believe Congress needs to consider reforms to these programs, specifically to allow greater flexibility with SBA loans for agriculture and to raise the cap on USDA Farm Service Agency guaranteed loans simply due to the rising cost of agriculture. There needs to be additional in-depth look and discussion in modernizing these programs, providing something as simple as electronic signatures. The guaranteed loans have allowed our customers to continue to get access from banks like mine as they grow, ensuring credit for bank customers across the country. We remain concerned, however, with competition on an uneven playing field, overburdensome regulations, and a lack of appraisers in rural America. Many small rural banks simply cannot survive. The result would be devastating to the local residents in those communities. Every day, my bank competes with other banks in part of Kansas, but we also compete with Farm Credit System, which is $300 billion GSE. This lender has a huge tax advantage over my bank. Currently, with a combined state and federal tax rate of 38%, we have to work until July just to pay our tax bill. There needs to be serious discussion on leveling the playing field between banks and farm credit. In addition to unfair competition, banks have to deal with ever-changing and expanding regulations. Due to the Dodd-Frank Act, a bank like mine has to outsource much of our compliance, and we are more than paying a full-time teller salary for compliance and outside audit teams. The impact is one fewer bank employee serving our customers, one less paying job in a rural community. Due to regulations, many banks in rural Kansas have moved out of the mortgage lending business completely, often due to increased compliance. What used to be a staple for every community bank is no longer even a product offering. When you consider a bank like mine, where we keep our loans in our portfolio, we are taking the risk, and any adverse decision affects our bottom line. This is why I believe if the loan is held in portfolio, it should automatically be a qualified mortgage. Through regulation, our loan closings have become much slower. We've had to hire an outside consultant to assist us in completing a pre- and post-closing review. In my area, there are many more houses on the market now. I believe it's partially due to the increased time it takes to close these loans. This only further slows down an already slowing rural economy. On a real estate loan, the bank no longer makes a credit decision. The bank makes a compliance decision to determine if a loan will be made. Lastly, there are a lack of rural appraisers, not just in Kansas, but across rural America. Increased regulations have made it harder for someone to become an appraiser, and especially hard for young people to get into that line of work. Lenders need appraisers or they cannot close a loan. Congress should examine the current rules of becoming an appraiser, especially in rural areas, so banks can continue to lend effectively. Banks like mine are proud of the work we do to support our rural communities. However, it will be very difficult to simply to survive, to continue lending to our customers and provide for our community and your constituents if there are no reforms to the many obstacles that stand in our way. The lending decision should be made locally to customers by their community bank, not by rules and regulations from Washington, D.C. that doesn't understand my business or my customers. Thank you. I'd be happy to answer any questions you might have.
Thank you, Mr. Haynes. I appreciate your testimony and joining us today. I now yield to Ranking Member Chu for the introduction of our final witness, Mr. Marcus Stanley.
Yes, I'm honored to introduce Mr. Marcus Stanley. Marcus Stanley is the Policy Director of Americans for Financial Reform, a coalition of more than 250 national, state, and local groups who have come together to improve regulation of the financial sector. Members of AFR include consumer, labor, civil rights, investor, retiree, community, faith-based, and business groups, along with prominent independent experts. Dr. Stanley has a PhD in public policy from Harvard University and previously worked as an economic and policy advisor to Senator Barbara Boxer as a senior economist at the U.S. Joint Economic Committee and as an assistant professor of economics at Case Western Reserve University. Dr. Stanley, thank you for joining us today.
Thank you for that introduction, Mr. Stanley. You may begin. Thank you.
Thank you. Chairman Huelskamp, Ranking Member Chu, and members of the committee, thank you for the opportunity to testify here today. Today's hearing asks us to consider the impact of the Dodd-Frank Act on small banks. I want to make two broad points. First, community banks face economic headwinds that are unrelated to Dodd-Frank, connected both to long-term trends and to the effects of the financial crisis itself. Second, the big picture is that community banks have returned to profitability under Dodd-Frank. In 2015, just over 95% of community banks earned a profit. That's compared to 78% in 2010, the year Dodd-Frank was passed. Consolidation in the banking industry is not a new phenomenon. The number of FDIC-insured banks has declined by 2/3 over the past 30 years, with the decline concentrated among banks with less than $1 billion in assets. The number of community banks has declined every single year since 1984. The causes of these long-term trends include changes in economies of scale in banking and deregulatory measures that assisted the expansion of large regional and global banks. The catastrophic effects of the financial crisis made things worse. Over 400 community banks failed between 2008 and 2011. Facing huge losses in the Deposit Insurance Fund and a historically devastating recession, FDIC supervisors cracked down on risks in existing banks and made it more difficult to open new banks, a regulatory response that would have occurred even if the Dodd-Frank Act had never passed. When we look at the well-being of community banks since the passage of Dodd-Frank, as well as specific provisions of the law, we see a better picture. Not only have more than 95% of community banks returned to profitability today, but return on equity has been steadily increasing. Average community bank ROE has gone up every year since the passage of Dodd-Frank and reached almost 9% in 2015, a level that some larger banks such as Citigroup or Bank of America might envy. One reason for this is that in drafting Dodd-Frank, Congress made major efforts to shield small banks from additional regulations targeted at the large banks and non-banks who were at the center of the 2008 crisis. Smaller banks are exempted from numerous provisions in the law, including new heightened prudential standards in Title I, new over-the-counter derivatives regulation, and direct CFPB examination. As detailed in my written testimony, regulators have continued this practice in implementing the law, with efforts to shield small banks from compliance burdens in areas ranging from the Volcker Rule to new mortgage regulations. The Dodd-Frank Act was major legislation passed in response to the worst financial and economic crisis since the 1930s. So it clearly does have impacts throughout the financial system. But those impacts are concentrated on the large banks and non-banks that are, in fact, the major competitors of community banks. At the same time, I do not wish to imply that there are not real issues with small business access to credit and issues in rural areas that this committee can and should address. Although small business lending has increased significantly in recent years, it has still lagged during the recovery, and the economic expansion has been more concentrated in urban areas. Helping small banks to address this issue should be high on our agenda, but looking at the Dodd-Frank Act as it's caused seems misguided. Instead, I would urge the committee to look at credit guarantees from entities like the Small Business Administration, the Department of Agriculture, and other forms of credit that are under the jurisdiction of the committee. We must also make sure that non-bank financial entities are competing on a level playing field with regulated banks. Online marketplace lenders are a rapidly growing provider of small business lending and are subject neither to consumer protection laws nor risk controls. The evidence indicates that they often provide a substandard and even exploitative product. Just 15% of small business borrowers from online lenders express satisfaction with their experience, while 75% of small business borrowers from community banks did. That's from a joint study by 7 regional Federal Reserve banks that covered pretty much the whole country. Congress should consider expanding oversight of online marketplace lenders. Thank you for the opportunity to testify, and I look forward to taking questions.
Thank you, Ms. Stanley. We appreciate your testimony. We will now begin our questioning. I recognize myself for 5 minutes. First start with Mr. Haynes. I can't imagine you got into this business to navigate your way through miles of red tape. What brought you in this line of work, and what do you see as your role in the community of Elkhart, Kansas?
I've been a community lender for 20 plus years. Don't want to give the exact number, but I enjoy being part of production agriculture. Growing up on a farm myself, that was my lifestyle, and that was my livelihood. Now I get the opportunity to help a number of customers continue their lifestyle and continue their goals. Being in a small community, being with the bank and being a leader in that community, you're on a number of boards. And we understand how vital it is to keep our community together, to keep our community whole. We need new businesses. We need people coming to town. The bank is the lifeblood of that. That is who's going to be able to bring those individuals to town. That's who's going to be able to fund those loans to allow them to realize their dreams. And that's what I enjoy doing, is seeing some may be able to start their own business.
We talked a little bit about home mortgage lending, perhaps small business loans as well. I'd like for you, if you could explain how the regulations have restricted your ability to meet those needs, and secondly, who will take care of those needs if the First National Bank of Elkhart were not there?
That is a huge challenge from our side. I brought a couple things I'd like to show. When I came to banking 20 plus years ago, this was a real estate note. We had a note, green, nice, pretty form, being a bank, and a mortgage, and that was it. We could get a customer would actually read that, understand it, ask us questions. This is now a real estate note. It's half-inch thick, lots of pages to sign. We couldn't get a customer to read this if we kind of forced them to. It's just flat, too thick, and we've taken it from something simple to something overly complex. In our local market, we don't have a lot of secondary mortgage options. We were just informed some time ago that our secondary mortgage lender that has been a big supporter of Southwest Kansas now will no longer make a real estate loan less than $50,000. While that seems small, the average loan size of residential loans in our portfolio, $33,000. And so there wouldn't be anybody in our portfolio that would even qualify to apply for a residential loan. And that's, I understand that's not a jumbo loan in your line of work, but at our house, that is a house loan. That is a typical house loan. We have to continue to serve that market as best we can, but we have to figure out a way that we can do it within the regulatory constraints, and that's the challenge that we're not meeting.
I'm hearing this from other communities as well, and who's going to issue the home mortgage in these situations? I know many of the folks in Kansas Banker Association, perhaps in Oklahoma as well, exiting the marketplace.
Yeah.
Mr. Stanley's worried about online and some of these other entities, but what are the other options you have?
There's not a lot of options because we don't have our customers don't fit the model. They don't always have a W-2 that allows them to get paid, once a month, and so then it's an easy way to figure their income. They have farm income. They have Schedule Fs, and so it doesn't fit the box. And that's really the loans that we wind up with. The ones that don't have access can't get access to those other markets, and so as a result, they have limited access to credit.
Yeah. Thank you, Mr. Haynes. Mr. Beveridge?
If I might add to that just a moment, Mr. Chairman, as I said earlier, banks are fairly resilient and try to figure out a way to meet their customers' needs. One of the things that has happened in Oklahoma is that our Bankers Bank has created an opportunity for referrals to Oklahoma City, if you will, for consideration of those rural mortgages. And it's because they do a lot of them that they're able to withstand the litigation and regulatory risk that a much smaller bank cannot. In addition, one bank family has created a mortgage business that they too offer, but since you're giving it up to your competitor, you might not get quite as many referrals to that instance. My point is that with that referral also goes access to the community bank. And it's that relationship that is at risk here. It's that relationship, that reliability, the trust, the bond of trust that a banker like Shane has with his customers. Because a community bank is just simply so much more than a bank.
And does Dodd-Frank understand or take into account that at all?
Some of the language does, but in the real world, no. And the answer is based on the reality that the mentality is one size fits all. A friend of mine had a $15 million bank, very, very small, 3.5 employees. He has to do the same thing that J.P. Morgan Chase does. And he makes cattle loans and he makes wheat loans. That's it. He doesn't do anything else. He doesn't have any derivatives. I mean, I'm not sure he could spell derivative. But nevertheless, he's just a simple community bank in a simple little town of about 250 people. He just sold because he couldn't deal with it anymore. And he's not the only one that's going to do that. And that's part of the issue. My question to you, Mr. Chairman, is if rural community banks go away, who's going to finance the business of food production?
Yeah, that is a worry I have as well as a farmer and a resident of small town America in western Kansas. Thank you. I next recognize Representative Chu for her questions. Thank you.
Yes, Dr. Stanley, low-income and minority neighborhoods were devastated by predatory mortgage lending in the years leading up to the housing crisis. Do you think these communities are better off today with the ability to repay in qualified mortgage rules that were enacted under Dodd-Frank?
Yes, I do. One thing that we saw prior to the crisis was people with equity in their homes being targeted for exploitative loans that they could not pay back, at which point the bank would seize the collateral and perhaps profit on a loan that never should have been made. And I do think that the QM and the ability to pay rules have made a critical difference in a lot of areas across America and will make a critical difference in addressing that.
Well, small financial institutions are particularly critical of these rules. How has the CFPB, the Consumer Financial Protection Bureau, specifically tailored the rules to account for the relationship banking model of small institutions?
Well, the CFPB has made a lot of efforts to do that. And one thing we've heard several times from the other witnesses, the desire to exempt on portfolio loans that are held in portfolio from regulation. That can make sense for a bank that truly has a relationship lending model. And the CFPB has, in fact, exempted loans held in portfolio from many of the requirements under the new mortgage rules. So it's been very responsive to that. But one thing I think we see here in Washington, D.C. is that when you actually look at legislation that would roll back parts of Dodd-Frank and would do things like exempt loans held on portfolio, you see it doesn't just apply to small rural banks. It doesn't just apply to community banks. It applies across the board to large regional banks. And frankly, the reason that legislation draws fire from organizations like Americans for Financial Reform, from proponents of reform, is that it's not limited to the kinds of banks that we're talking about here today. And I think that there really is space, both with regulators and even possibly in Congress on a bipartisan basis, for legislation that is truly targeted at the kind of small rural banks we're talking about today.
Yes, Mr. Beveridge.
Just to add something to what Mr. Stanley said about the CFPB and their willingness to accommodate some of these issues, he's correct, but it's taken a while to get there. One of the things that we've done is that we've invited CFPB employees to come to Oklahoma. 2 of them have taken us up on that, and I've taken them to small rural banks to show them how they work. I think that has had an impact as it enables the CFPB experts to understand the differences between a $40 million bank in Allen, Oklahoma, and Bank of America. I think that's important. But Mr. Stanley's
thank you,
right. It's
yeah.
getting better.
I do appreciate that greatly. And Dr. Stanley, the CFPB is required to carry out extensive analysis before issuing regulations that will impact smaller institutions. As you know, a number of changes were made to accommodate small rural lenders under CFPB's mortgage rules. Do you think the small creditor exemption provides community banks with the flexibility to continue making the mortgages that are the best fit for the customers?
Well, the small creditor exemption does include a lot of additional flexibility on things like balloon payments, escrow requirements, on debt-to-income ratios and these kinds of things. And I think that is the kind of flexibility that we need to see in small rural areas, yes.
We've heard that on many occasions that the Dodd-Frank is the reason for many of the problems facing community banks. Can you explain how the Dodd-Frank Act can actually do the opposite and help level the playing field with their larger multinational competitors?
Yes, I mean, what we saw prior to the crisis was large banks gaming the system in a lot of ways. They would use complex internal models to claim that their assets were less risky than the assets held by smaller banks. And they would use that in order to hold less capital and borrow more, be over-leveraged. And Dodd-Frank has taken a lot of steps to even that. And I think the CFPB's jurisdiction over non-banks is also very significant in terms of leveling the playing field.
And can you elaborate on your testimony regarding the issue of the declining number of community banks and the role of the FDIC's supervisorial practices?
Yeah, I mean, I think that there's no question that the FDIC cracked down as a supervisor on a lot of bank risks in the period around the crisis. And I do think a lot of that was justified because there were a lot of banks that had made loans in the commercial real estate space that I think those valuations were inflated. I think as the economy was damaged, some of those risks were excessive. We saw a lot of banks failing, and the FDIC was concerned about that. They did crack down. I think there are issues and questions. They also cracked down, as one of the witnesses mentioned, on the opening of new banks and put in sort of new requirements because they saw a lot of newer banks fail during the crisis. And I do think that's something that could be re-examined and thought about in terms of how they've done that.
Thank you. I yield back.
Next, I recognize Representative Trent Kelly for questions.
Thank you, Mr. Chairman, and thank the witnesses and ranking member, and thank you, witnesses, for being here. Community banks are very important. I'm from Mississippi, and I'm in a rural area with a lot of manufacturing, a lot of agriculture. And community banks, quite frankly, it used to be the post office was the center of gravity for most small communities. The post office has consolidated. So now you have a town because you have a community bank. And when you lose that bank, you lose the town. And it's not just the banking, it's the guys who coaches softball or kids baseball with you. It is the guy who goes to church with you on Sunday and sits by the pew. Your banker in those small communities is much more than your banker. He's a confidant, and I understand that. Unfortunately, based on your testimonies here today, it's not just Dodd-Frank. I can tell you my bankers don't have the same view as Mr. Stanley about Dodd-Frank and the impact it has on small banks. I can tell you that they have talked to me again and again. I can tell you that the regulations are 5 binders this thick that they have to comply with, and they don't get paid for compliance. They have to comply with that, and they don't have the expertise, and so the net effect of that is a cost to the consumer, which has to be sucked up by the consumer because it is a non-revenue generating process. Based on that, just how do you think, what is the impact to the end user, to the consumer, that Dodd-Frank and other regulations have on the consumer and the financial ability to get along? Mr. Haynes.
I appreciate the question because that is exactly why I'm kind of here. That's been the big challenge where I testified earlier. It used to be a source of pride with our little community bank that we would, when we do audits or something internally, we would outsource. We would use it as a cross-training opportunity. We'd grab somebody that might be from the other side of the bank, and have them audit a loan side, or have a loan side audit an operation side. And it was a way we could educate, we could cross-train, we could bring that next level of leaders into the bank. Because they have gotten so thick, so heavy, and frankly, they're ever changing, we can't do that anymore. We don't have the expertise. We can't have the expertise in our little 20 employee shop to have that level of expertise. And so what we've had to do is we've had to outsource that to outside firms that come in for a period of a week or a few days and do those audits. Well, that comes at a cost. And in our respect, we're paying more than a full-time employee's salary to outside firms to come in and do audits that we used to be able to do ourselves. I don't have a problem doing the audits. I don't have a problem following the regs, but they've just gotten so large, so cumbersome, and frankly, so they seem to change that we can't do that anymore. And so the effect, one less employee, one less teller serving our customers don't get as good a service, one less job in the community, because you're right, we are the t-ball coach and the swim coach and the basketball coach. It's one less job.
Let me follow up on that a little bit, because my community seems like it's a lot like yours in Elkhart. A lot of my loans are not $50,000. Those bankers, and a lot of times it's for homes. Number one, because the real estate prices are much better in rural areas. You can get a lot more house for a lot less money, but also because of the same economic things where you don't have the steady W-2 necessarily. What impact, and just kind of expand a little bit on the impact that it has for those $50,000 or less loans, that folks aren't going to be able to get that money anywhere, which means they don't have a house and those things. Can you expand on that just a little bit?
Sure. Thank you. I appreciate that. The biggest house loan in town probably wouldn't struggle to get to 6 digits. We don't have that large of a house market. The largest sheer number of people looking for house loans don't need, and wouldn't ask for a loan in 6 digits. They're looking for that $50,000 to $60,000, $40,000 house to get them started. If the secondary market is not an option, because they simply won't even take an application if it's under $50,000, because they have determined anything below that is not profitable for them. So then their only option is their local community bank. And the majority of the banks around me don't make residential real estate loans anymore. And so as a result of that, they have far less access to credit than they would have had before. And it's put them at a disadvantage, both now and for the long term. They can't own a house.
Mr. Chairman, if I can, I'll let Mr. Beveridge comment.
I just wanted to add to what Shane said. The primary impact on consumers is that it increases their costs. In a rural area, you simply don't have a pool of compliance officers who are knowledgeable about everything that's going on and everything that's required of a bank today. So you don't have any choices, regardless of what you would pay them. So you have to outsource. You have to use the association or a program that we would sponsor, or your own private expert to help you get through what at least the OCC has told us is the principal issue for examinations. Compliance is 1, cybersecurity is 2, credit is 3. And that's important to understand.
My time's expired. I'll yield back, Mr. Chairman, and thank you.
Thank you. Next, recognize Representative Lukemeyer, and Vice Chairman of the committee. Welcome to the subcommittee.
Thank you, Mr. Chairman, and glad to be with you. I also serve on the Financial Services Committee, and so we've been working on some Dodd-Frank issues and Dodd-Frank reform, and we've had a lot of testimony. Let me just read you a few statistics. Before Dodd-Frank became law, 75% of banks offered free checking. Now only 37% at the end of 2015. Dodd-Frank fueled a 21% surge in checking fees. 15% fewer credit card accounts since 2008 at a cost now of more than 200 basis points more than what they had. 73% of community banks report regulatory burdens are preventing them from making residential loans. We've heard the testimony. And another one last number here. The cost of smallest commercial industrial loans has risen at least 10% from pre-crisis average. And I can tell you, I'm from Missouri. At the end of 2015, we had 44 banks that were $50 million or less. Those are little bitty guys. But remember, we're talking about small rural communities, and that's probably the only bank in town, like probably yours is, Mr. Haynes. And those guys, out of the 44, 26 lost money last year. FDIC did a study back in 2013. It said within the next 5 years, any bank $250 million less is probably going to go out of business. Not because they're bad banks, not because of the economy, but because the rules and regulations that are coming are going to force them to consolidate. And Dodd-Frank is the culprit. Dodd-Frank created all of this new whole group of regulation that's out there. And Mr. Haynes, you talked a minute ago about QM rules. QM is, at your size, you're supposed to be exempt from it, right? But if you want to sell a mortgage to the secondary market, do you have to comply with it?
Yes, we do.
So even though you're exempted, you still have to comply. So these rules roll downhill, don't they?
That's the part I'd like to say. Ms. Chu, we were supposed to be exempted from a lot of Dodd-Frank and that threshold. I understand that. But what happened, whether intentional or probably very unintentional, was the trickle-down effect. Exactly what we're talking about, that what is a best practice for Bank of America, then the examiners see that and they see, well, that's a nice stress test, that's a nice little study. Why don't you guys do that too? And so it trickles down to where all of a sudden we're doing that same thing, where Bank of America, the big banks, they might have a team, a department, a program that they developed to handle that. We don't. We've got Excel. And so we have to come up with something that's going to work. And so that trickle-down effect is what we weren't exempted from. And so I agree that that is a challenge.
I got another question for you just a minute, Mr. Beveridge. I have another question with regards to Dodd-Frank. You know, we're losing one community bank a day across the country right now. And the Dodd-Frank was supposed to be the cure-all here, supposed to keep the big guys under control. But I believe, let me make this statement, and Mr. Beveridge, I'll appreciate your comment on it. I believe Dodd-Frank has caused the big banks to get bigger and put the pressure on the small banks to go out of business and merge with them. Would that be a fair statement?
Oh, yes, sir. I think that it doesn't tell the whole story, but it is certainly relevant. One of the things that I wanted to add to what Shane said, and it responds to what Mr. Stanley testified about, and that is the exemption that banks under $10 billion are supposed to have from the CFPB. Well, they do have exemption from direct examination authority, although there is ride-along authority, and that's a different issue. But they're not exempt from the rules and regulations that the CFPB has revised and imposed. They still have to follow those. And the primary federal banking regulator is then the one that examines for compliance. And in smaller banks, that's a cost that doesn't bring a dime to the bottom line, which means less capital and, more importantly, less ability to lend to consumers.
Okay, very quickly. My experience has been in discussing this with bankers across the country, all different sizes. And I've asked this question a lot of them, and they say, anytime, because of the increased costs of compliance and the complexity of it, when you hire a loan officer, you've got to hire one compliance officer. And so when you look at these small banks, you hire a loan officer, the compliance officer doesn't make any money. And so you have to spread those costs out over your bank, and you reach a point at which the rubber band breaks and you have to do something different. And this is where they're at. I think I go on all day here, but I see my time's about out. But I think that I appreciate your gentleman's testimony this morning, and I think that, you know, small banks make loans to small businesses. That was a testimony in this committee not too long ago. And I think that we need to make sure we keep the banks in business so small businesses have an access to credit ability. Without that, your small businesses, your communities dry up. And whenever rural America goes away, it hurts the ability to produce food and produce all the rest of the things this country relies on. Thank you very much for your testimony today.
Appreciate those questions, and I will note Mr. Haynes has come a long way, and I'd like to ask him another question. And I think you drove 100+ miles to an airport, then took a connection, two of them, to get here. So it's come a long way. So one other subject you did bring up, Shane, is that you thought unfair playing field in the particular area of agriculture, and which is the bread and butter of your bank, and it's hard to compete. Can you describe that a little bit more, and what would you suggest as the ways to level that playing field?
I believe there are several ways. I believe you're referring to farm credit services and their tax exempt status on real estate loans. I believe they currently have a tax rate of about 4%. Well, if you compare that to my 38% bracket, that's a huge unlevel playing field. There are several ideas that I would like to consider. The biggest and the most obvious is they don't pay income tax on income earned from interest on real estate loans. Give us that same opportunity. I don't mind competing with anybody, and that's what made America great. But let us compete on a level playing field, and don't let me start 34 percentage points behind them on a tax rate.
Yeah, appreciate that. And I want to follow up with Mr. Stanley and trying to understand your perspective, what's occurring here, and I don't know if you've ever been in a small town or a community bank we're talking about, looked at that, but frankly, Mr. Stanley, I don't know how they're able to compete with the Bank of America. And the regulatory changes or the legal changes coming out, hopefully at a Financial Services Committee, Bank of America doesn't want the changes. They don't want to change Dodd-Frank. They like the setup. As I understand, they're opposed to making changes. They found out how to game the system. But when you have Mr. Haynes and other banks across western Kansas, I think we all agree we want consumers to have more options, not fewer of them. But when I hear from my community banks that they're saying any loan under $100,000, and there are very few of those, are losers. They're going to lose money on them, and the feds don't want them to do it anyway. They're left with some of the predatory lenders you're talking about. And Bank of America is not going to come to Elkhart, Kansas. I guarantee you that. They have no desire. What they want to do is maybe buy up your bank. I don't know what they would want to do. I think they just want to ignore that. So I'm just trying to understand from perspective in the group you represent, which in inner cities, I think you saw those predatory practices. But how does that apply to a small rural town? And if they're going to have no options when we're done with Dodd-Frank, in my opinion. So I'll open it up to you, Mr. Stanley.
Yeah, I think first of all, I think you're going to see a lot of large financial institutions that end up supporting that package that comes out of Chairman Hensarling. But I think that there is enormous diversity in the American banking system. We have 6,500 banks across all different sizes of communities. And I think that what we're very focused on and concerned about is that any changes to tailor these regulations, and there have been changes made both at the regulatory level and in the Dodd-Frank statute, that changes to tailor these rules don't become loopholes that can then be used by larger banks or can be used in sort of rent-a-charter situations where somebody gets a bank charter and then sells stuff out into the secondary market that doesn't meet certain kinds of standards. And one thing I see with a lot of the legislation that comes out is it's not limited to the kinds of banks that are in Elkhart, Kansas. It's not limited to $100 million banks, to $250 million banks. It does open the door to either banks that are in that $50 to $500 billion space, the very large regional banks that are among the largest couple dozen banks in the country, or even to the top 6 or 7 global banks that dominate Wall Street. And I think that there is space. There has been space in the Senate, and actually there was a package passed for community banks that was limited to community banks. I think there's bipartisan space for legislation that is very targeted and crafted to the kinds of banks that you're talking about in Elkhart, Kansas, but we just don't often see that.
Do you think they present any threat to the economic system? Why are they being punished by these regulations at all? I mean, we've got experts. They spent hours and days, weeks and months and years of putting it together. At the end of the day, Mr. Haynes comes in and says, yeah, most of my competitors leaving the marketplace. And the big cities said, well, that's just too bad. You can't get a home mortgage in Elkhart, Kansas. That's just one of the cost of taking care of the big banks. So but I agree with Ms. Lukemire. The end result is they're too big to fail and too small to succeed. And I think that's happening in this arena.
Would you like me to respond?
Oh, please.
So I think there's a couple things. First of all, with respect to consumer protection, if something happens that damages a consumer, that consumer it may not matter to that consumer whether that happened at the hands of a small bank or a large bank. And I think, you know, the vast majority of cases, there's no intent to harm consumers, but some of these rules that we're talking about, overdraft fees, things like that, the Card Act that affected credit cards, that probably doesn't affect you guys as much, but overdraft fees were a source of revenue for small banks. There were abuses in terms of overdraft fees, and you know, there were consumer protection things that were done to address that. Interchange fees, that's something that there were complaints about from small businesses, but small banks had issues and problems with the regulatory changes that were made for interchange fees. So that's one set of things on these consumer protection things. And I think in terms of prudential protections, we do have to remember that even if you don't threaten the national or global financial system, you are dealing with insured deposits. There is a backstop, a government backstop behind those deposits, so there is an interest by the FDIC in prudential risk regulation as long as those insured deposits are there.
And Mr. Stanley, I appreciate that, and I will note I do not know of a single bank in the western half of the state of Kansas that failed in this situation. But they get to take on all the regulations, and so I'm not worried so much about consumer protection. I'm worried about they won't have any more choices. And we'll probably be sitting here in 3 or 4 years saying, gosh darn it, what are we going to do to make sure they can get a loan in Elkhart, Kansas? Because we are about at the end of that, at that stick. So I would ask Ms. Chu or Ms. Lukemire, being a little flexible here, if you had any follow-up questions, seeing none, or Ms. Lukemire, if you had another round of questions.
I got a couple more here, just to, you know, Mr. Beveridge, we've been discussing a little bit about new banks being chartered. You know, there's only been, what, 2 in the last 5 years, I think.
Maybe 3.
Maybe 3.
Yeah.
You know, if you're an investor and you go out here and you see the numbers we've been throwing around here today, especially small banks, if you're an investor, why would you want to invest in a business like this where you're going to get regulation from the top down and continued more of it? I mean, the CFPB is just out of control with the TRID rule, the QM rule. They basically run real estate mortgages out of the existence in small communities. And so if you're a new bank trying to get started, what are you going to make loans on? So, I mean, can you give me some insight as to, I mean, I don't see why an investor would go in and try and start a new bank.
In this environment, neither do I.
Yeah.
And I would advise against it. Until we get some changes that will help community banks serve consumers in ways that don't jeopardize them. I just can't help but say this. Community bankers do not get up in the morning thinking about how they can screw their customers. They get up in the morning thinking about how they can take care of them, because those customers are vital to the survival of that community. When a bank makes a loan, basically there are 2 questions. You know this. 1, can you and will you repay it? And if all of that works, then the bank wins, the customer wins, and the community wins, because you get jobs, you get economic involvement, you get economic activity. These people grow up together, for heaven's sake. They know everybody. They've got a list of things that they can no longer do because they're afraid of fair lending allegations. They're afraid of if I screw up on an appraisal or on a valuation, or if I don't dot an I or cross a T properly, I'm going to get sued. Now, rightly or wrongly, that's a fear.
One of the problems with the QM rule is that by saying it's a qualified mortgage means that it's a qualified mortgage, inferring that it's a preferred mortgage. And if it's a non-qualified mortgage, they're by inference is saying, oh, there must be some additional risk here. There must be a problem here. So it opens you up as a banker to a lot of liability exposure, even though it may not be. But the inference, it's a non-qualified loan. Just by differentiating between the two, suddenly now you're put in a position to decide, is there liability risk that I've got to take care of by making this kind of a loan, a non-portfolio loan? This is the predicament that the banks are in from the and this is why you wind up not making real estate loans and getting out of the business, because you see the liability situation that sits in front of you like, I can't take this risk.
That's
Mr.
exactly
Gaines,
right.
I see you've been jumping in, anxious to jump in here.
Sorry, Mike.
Sorry about that. Number one, I think I said earlier, we are now making a compliance decision, not a credit decision. When we look at a loan, And that's wrong. That's not what we are built to do. That's not what we should be doing. But we are making a compliance decision. Are we going to make this loan? Is this one that we're not going to get written up for later? Is this one that we're not going to have to re-disclose everything because we got something on the wrong line? And so it's a compliance decision to not make a loan versus a credit decision. But I'd like to follow up on your original comment there about I had an opportunity in 2011 to put a holding company together to buy the local bank. And that great source of pride and a great opportunity. And so I've actually gone down that exact path. And to follow up on what Mr. Stanley said, community banks have become profitable in spite of Dodd-Frank, definitely not because of Dodd-Frank. We continue to work around and with those rules. The reason you invest in a local small bank, I can tell you, because you want the bank there. You don't want it being sold. You don't want it closed. And so the group that we put together, they grew up there. They want their local bank there. That they grew up knowing that was their bank and that's where their kids banked. And we still have those kids that are now customers, and they've moved on to California or wherever, and they're still our customers. And so the reason you get investors to invest is because they want their local bank and they want to be a part of their local bank. We're not getting investors from outside. We're getting investors from down the street and across the street.
And just to show how honest, I didn't bring it with me this morning, but I've got a sheet at home that details how you go through a real estate mortgage, and there's 247 things on this sheet of paper here that you go down and you check a box. Okay, it's this size, so you go here. Then it's got this kind of collateral, so you go here. It's a sole proprietorship, or it's a husband and wife, and you go here. There's 247 ways you can get tripped up when you make a loan. That's all out of a lot of that's out of CFPB. That's their problem. QM, CFPB's own sheet is like this. You take two sheets and you put them together like this. It's like a Rubik's Cube. You go through here, you go out here, you go here, and then you wind up going on this one and go here. Like, it's unbelievable. And so you wonder why banks get out of lending. You wonder why they're getting exposed to this. You wonder why the costs of consumers go up. Somebody has to pay for this extra compliance cost when you have one loan officer per one compliance officer. Thank you, gentlemen, for being here today. I yield back.
I'd like to thank all our witnesses for their participation today. It's never easy to take time out of your busy schedules and to come and talk with us, but you have helped us understand the unique impact of overregulation can have on our rural communities. All too often, it's our consumers, our small businesses, farms and ranches, and entrepreneurs who ultimately feel the burden. Here at the committee, we remain dedicated to working to ensure that small businesses are allowed to grow, thrive, and provide economic opportunities to their community. I ask unanimous consent that members have 5 days to submit statements and supporting materials for the record. Without objection, so ordered. This hearing is adjourned.